We're talking about Silicon Valley and the impact on coronavirus on the real estate market, and essentially it has been very little, fortunately, in the long run. Just a little housekeeping. This blue is the base URL. You add the blue suffix to get to the different things. Today's handouts were posted about 4 minutes ago, so they're there. Just type in the base URL, handout singular, and then the 8-digit date code 2020-08-15, and you can get that now or later. Or you can just enjoy the slideshow. Here is the same information, a little cleaner so you can see it. I will do interactive today, so if you have questions, try to keep it concise, but feel free to interrupt at any time. This is the first thing. This is looking at my benchmark data. This is 5-week data, single family homes only, Santa Clara County only. And what you can see here is anytime the red, which is the demand, the number of offers accepted, is above the blue, the inventory, you're in a hot real estate marketplace. So before COVID-19, we were in a hot marketplace. COVID-19 took us down into a buyer's marketplace. Very short-lived, basically during the period of time when we couldn't show houses. The market rapidly came back up into the seller's marketplace where we've been ever since. This looks at the key indicator, days of unsold inventory in the blue line. You can see the same pattern. We were in a hot marketplace, the red rectangle down here. Days shelter in place happened. We slowed way down. We could start showing houses, the market improved, and we're back down right to where we were beforehand. The other two slide data points, the fuchsia line here is the median days on the market, which says how long does it take half the sellers to sell. You can see that prior to shelter in place, you were at 8 days, which is an extremely fast marketplace. Shelter in place happened, the MLS froze days on marketplace, so it came crashing down. And what this means when it hit 0, it means that half the homes that were selling were listed during shelter in place and selling during shelter in place. And then as we could come out and show properties, the MLS started counting days. This is not the market going downhill. It's just coming back up to the steady state. We got up to 10 days. There's a little bit of improvement. We're at 9 days. So that's pretty accurate. Average days is going to lag behind a little bit and really still isn't, in my opinion, accurate. And that's because the sellers that were on the market for a long time when shelter in place happened are going to be the ones that tended to take their homes off the marketplace. So we got rid of all the listings with high number of days on market. So that keeps your average down. This is price. Most people just follow the median price, which is this middle line. I follow the median as well as the 10 percentile, which is what the cheapest homes in an area are doing and the most expensive homes. So this is the 90 percentile, the 50 percentile or median, and the 10 percentile. So what that says is 80% of all homes sold are between these two lines, the outer two lines. There's 40% between these lower two lines and another 40% between these upper two lines. Between the outer boundaries, all 80% of the homes are. Now, an astute observer will notice that the solid line here is August the 7th. The dotted line is the 14th, which is basically because I have the data as of midnight last night. But you go, wait a minute, how do I have data out here until the future of next week? And that's because I normally look at things on a 5-week average. The first little segment after here is based on a 3-week average, then a 1-week average. You can see the lower price percentile went up, the higher percentile went down, the median's basically pretty flat. I'm probably going to stop calculating the future stuff in a couple more weeks, but I just want to make sure it doesn't tell me anything valuable. The most important as far as the buyers are concerned, and that's because this is what the other buyers are feeling. And this is what percentage of the buyers are willing to pay more than the seller's asking price. So right now you can see where the blue line is into the red box, which means we're above 50%. So more than half the buyers that are successful in getting their offer accepted are paying the seller more than their asking price. There's another line up here that's a little bit hard to see because it gets right there on the red rectangle, and this is how much are they willing to overbid. And you can see before shelter in place, they were willing to bid about 106% above asking price. Now they're only about 101.5%. So, and that tends to happen after every impact, whether it be 9/11, a recession, or shelter in place. Buyers are more stingy on their money and how much they're willing to overbid. So instead of overbidding 10%, they may only overbid 5%. So on average, that number is now about 101.5%. And this gives the buyer some idea what his other buyers are sensing in the marketplace out there. This now is looking at overbidding for a single family home in Santa Clara County. And what I'm doing is looking at 1 week data. I don't know why this says 5 week data up here. This is 1 week data because you can see this is the 14th. The next line back is the 7th of August. So let's do a little background. This line out here is the best month we've ever had. And basically each line is a sale price to list price distribution for that given week. The historical stuff here is monthly in the blue down here, but everything else in here is weekly data. So this is the best month we've ever had, and that turned out to be August of 2017. And by best, that's the most overbidding, the most aggressive overbidding. The best August that we had, since we're in August, was August of 2018, so just 2 years ago, and we were basically at this line. So you can see there's a big difference between April and August, because April and May tend to be our best months, most aggressive months, and that's why it was higher than our best August. Conversely, we're looking at the coldest month. So this is the coldest month ever, and that was December of 2001. And then the worst August ever was August of 2001. And then these are the most recent 20 weeks in between here. And there are groups of 8, with the most recent ones being solid. So the red one is the current week, and it's right here. And you can see it's basically, you know, and the dashed lines are the next oldest, and then the dotted lines are the oldest. So basically, the way I'm reading this graph is the dotted lines are, you know, basically back in April, and now those are going to be closing transactions that were pre-shelter in place, and people were coming in down into shelter in place. So we were crashing downwards. The dotted line, the dashed lines were basically beginning of May and into June maybe, and they're turning around and coming up. And now the solid lines have been bouncing around a little bit. You know, how much change there is between any of these lines, you know, not too much in my opinion. You know, the brown line here I'm picking up is June 26th. The red line is red to make it jump out as the most recent. You know, there isn't really that much change, but you can see we're not that bad. You know, we're not down here anywhere close to our worst months, basically in an improving direction, which is not bad in that time of the year when the market normally cools down. And I think that's what's basically happening. I think the market wants to improve, but we're going into a time when the market normally calms down. So we're basically in a balanced marketplace bouncing around a little bit. Now to clear up the data a little bit, this is just the same information. We got rid of some of the older data, and it's the same concept, but now we're only looking at 12 weeks, where the solid lines are the most recent, the dashed lines are the second most recent, and the dotted lines are the oldest. So the oldest data is the worst data, then you got into the dashed lines, and then you got into the solid lines. And now you can see a little bit more. You know, if I was to call it, I might say this mustard colored line here is better than the red line, at least on the top, you know, the buyers that are overbidding, the 20% of the buyers that are overbidding the most. You know, down here, you know, it looks like the red is outdoing the mustard line a little bit and outdoing it a little bit here. For the most part, here it's right on top of each other. So, you know, I might say that we've peaked, would be my sort of guess. There's no way to predict what the data will be for next week, and there's a little bit of data fluctuation, but I think we're slowing down. I think we're following in the absolute normal pattern of the real estate in Silicon Valley. Now we're flipping back to just looking at macro data. Macro data is something I normally don't follow. That is where I take single family homes, condos, and townhouses, lump them together for both Santa Clara County and San Mateo County. And this was done because, you know, people were concerned. What's shelter in place going to do? Is the real estate market going to crash? So in a way, it's a garbage data place, but it gives you a better feel of what the overall market's doing. And the reason, you know, I do some things like overbidding is good for this, because, you know, if a buyer feels he needs to overbid, you know, maybe he feels more in a single family home than a townhouse, but he feels it in all. But price would jump around a little bit more, I think, based on distribution. So some, I will go back to the 5 week. But you can see we hit, here's shelter in place roughly week 10. You can see that it basically didn't crash right away, and that's because there's a history as the offers that were negotiated before shelter in place closed escrow, and now you can see it came crashing down, and then it built up pretty quickly as we were able to show properties again. I never went back to look at what these spikes were, these valleys. They're not in my data from the best I can tell, so I think it might just be weekly fluctuation. When you're looking at 1 week and getting completely new data, you do have a lot more fluctuation, which is why I look at 5-week average typically, or 5-week moving data set. And you can see in the recent weeks where we've been going up again, and if you say that the typical escrow is 30 days, and this has been going up for close to 4 weeks now, basically 2 months ago, the market started to heat up again as far as the closings. This graph now is looking at each one of the components on a percentage of their 5-year median. So I took 5-year median, not including the current year. So I took 2015 through 2019, which were 5 great years in the local real estate market. I took the median of those data points and took a ratio of this year's data to that. So if everything was right at 100% and on the red line, we'd be a completely normal marketplace. So let's look at what's out of line. And the blue line, which is number of new expired listings, is out of line. And that doesn't particularly concern me, because I think what happened is when the shelter in place happened, there was a fair number of withdrawn listings. And as those withdrawn listings hit the cancellation date, they show up as a new expired, or hit the expiration date, they show up as a new expired listing. The other one that's out of line is the number of closings. And that one actually does concern me a little bit, especially when you come back up and look at the number of new offers accepted, which is the gray line, which is basically right here, which has been at or above the 100%. And the gold line has been, at here, close to at here, but basically always below the red line. So what's that telling me? If you have the normal number of escrows going into escrow, and you have an abnormally low number of escrows coming out and closing, that means your TFT ratio is up. And I think that is TFT rate, and that's the number of transactions that fall apart. And I think it makes sense that that's up. And the reason it makes sense it's up is buyers are a little more nervous, so it takes less of a spook to scare them away. Prices are also not going up dramatically, if at all, at this point. And so the buyers don't feel pressured to buy this house or pay $20,000 or $100,000 more for the next one. So they're willing to let a bad transaction fall apart and move on with life and start over again. The other data points are all right where you'd expect them to be. And now what we're going to do is look at each one of those data points. So the first one is we're looking at days of unsold inventory, because to me it's the single most important one. Let's start with the median. The 5-year median is this gold line. That's the historical. That's what we should benchmark things to. The blue line is the raw data, and the red line is the ratio between the blue line and the gold line. So here we're going sky high, and you might go, wow, that's good, because normally up on a graph is good. But remember, days on unsold inventory, the higher that number is, it indicates the longer it takes to sell a particular piece of all the inventory. So you actually don't want this to be going up. So this is a decreasing marketplace. So shelter in place, DUI skyrocketed. We could start showing properties, and then the market improved. And now we're basically right back where we are. And again, if we're right at normal, and normal is defined as the 5 years that were great, 2015 through 2019, we're having a great real estate market in the middle of shelter in place. Now we're going to look at the number of listings that are available without an accepted offer. And this is important because nearly everybody else includes some of the offers that are pending. They count anything that the listing agent wants backup offers. Basically, a pending transaction continue to show counts in, for example, the MLS inventory. So they're saying that we have an increase in inventory. I'm saying, no way, we're exactly at normal. The red line's almost perfectly on top of it. You can see how close the blue line and the gold line are. So even during shelter in place, for the most part, we were right on normal. So we've always had normal amount of inventory. So buyers have had the normal selection process. As far as number of new listings in a given week. So this is what new stuff came on the marketplace. And you can see there was a huge drop in the number of new listings, but there was a corresponding drop in the number of sales, which is why the inventory available stayed right at the normal levels. Fairly quickly after we could start showing properties, you could see that the blue line and the gold line, for the most part, were on top of one another. The fluctuation here, I think, was, if we went back and looked at it, would be July the 4th. So normally going into a holiday weekend, so sellers don't put their house on the marketplace. This year, they didn't put on their house on the marketplace, but a little bit less because it wasn't such a big impact because people weren't traveling as much. And so you actually had more inventory, more new listings during that 1 week. But basically, you look at this data and we're 100% at normal. Now we're looking at the number of new offers accepted. So in normal, once we got into shelter in place and after shelter in place, we've been exactly normal again. And that's the thing that's coming pretty clear. Here's the number of closings. Again, here's where we should be. And actually, this is an interesting line. This gold line is where we should be. The blue line is where we actually are this year. So this oval shape between the blue and the gold are the number of transactions we've lost. So we've lost a fair number of transactions this year. So if you take this data point, the worst one, you're maybe at 180, and you should have been up here at 480. You lost 300 transactions in that 1 week. And we're not making those transactions up. I know there was a lot of people hopeful that there would be a big rush and everything like that. I'm not seeing the rush. I think that this whole section of the real estate market's lost, and I don't think we're going to recover. And does that make sense? To me, it actually does, because I maintain real estate as an optional event. People got distracted by shelter in place and were doing other things and weren't focused on real estate. So the industry took a hit globally, and we're going to get on with life. And the market's returned, so we're not having the impact now, but we did have an impact. Number of new expired listings. Again, the blue line is the actual data. The gold line is the 5-year median. You can see the blue has been above, and which is why the red line's above the red horizontal. And again, I've already said that I believe the reason this is there was a lot of withdrawn listings that happened right here with the blue vertical line with the announcement of shelter in place. They're now expiring, so they're showing up as new expired listings. I think that's a fault with the MLS. I think if a listing was withdrawn, they should not be counted as an expired listing, but I don't get to make those rules. Moving on to canceled listings. This is where the seller and the listing agent agree to cancel a listing agreement that still has some period of time left on it. And you can see the gold and the blue are right on top of one another, so they're right on top of 100%. If you looked at it, you might say we're a little bit low. There's a lot of fluctuation, but that's when you're just comparing 1 week. A 5-week median, you do have to expect some fluctuation, and you can see how much the data is fluctuating every day. That doesn't concern me. And that's why I do a 5-week moving data set. Here's withdrawn listings. The first thing you'll notice is the historical stuff that's gone. And that's because, as I've already said, withdrawn listings become expired listings when their expiration date is arrived at. So there's no historical withdrawn listings. There is no such thing, because at some point in time, the expiration date is going to be reached, and therefore it's no longer a withdrawn listing. It becomes an expired listing. Now we move on to the overbidding, and this is based on single family homes in the different geographical area. This is going back in time, so this is back to July 18th, and because it requires sale price to find out if it was overbidding, it's even more historical. So you step through, there's the 25th, there was no change. There's August the 1st, there was only a little bit of change up here in Foster City. Here is the 8th, and Foster City disappeared. And here is the 15th, and now there's actually a fair amount of change. First one, I had a technical problem. So the areas that aren't colored are actually gray. So this area here should be gray, the coast should be gray, Saratoga Los Gatos should be gray, Coyote Valley, South County should be gray. But there's a lot more red. So basically, we're just getting to the point now where nude activity is finally hitting the overbidding at the closing. Now we're going to move on to unsold inventory, which is the most current data place. Now we're jumping back basically 29 days. I call it 5 Saturdays, 5 weeks. So this is the 18th. Moving on to the 25th, you can see the red expanded up in the San Mateo area. Moving to the 1st, the red went back, and this is just because you're right there on the cusp, so you have a little bit of fluctuation week to week. There's the 8th with no change, and here is the 15th with the change being these colors should be gray, but also the North San Mateo stuff went from a red to a balanced marketplace. Santa Clara County is solidly in a red marketplace. Gilroy, if I had intensity of red, would be the reddest, which is just phenomenal. I believe it's because people are willing now to commute down to Gilroy because commute's easier. And so they're going down there to get larger lots, larger houses for a certain set of money. Here we're looking at data as of this morning. Los Altos, Palo Alto went from a seller's marketplace at 37.5 days of unsold inventory to now a neutral marketplace at 45, and that favors the buyer. So for the most part, you can see the seller is ahead, especially in single family homes. If you go to condo townhouses, the buyer tends to come out a little bit better, and there's a few more areas that are the same. So then you do the same thing with frequency of overbidding, where I rate each one, so before, now, current, and whether the trend has changed, is favoring the seller. So here's another example. We're looking at South County. It was 37% of the properties overbid before shelter in place. That's a balanced marketplace. 43.8% are overbidding now. That's still a balanced marketplace, but going from 37 to 43 is more favorable to the seller, which is why the favors column says the seller. So same concept over here, but this is based on the magnitude of overbidding. And then finally over here, you go to price, and there is no price which favors the seller. So that's why the first two columns are not color coded, but then you go over to whether it favors the seller or the buyer, and it's pretty straightforward. The prices are up, or basically, because that's prices up would favor the seller, or the prices are the same. And in some cases, you know, they're real close, like 712 to 717. In other cases, 867 to 825. That's sort of right in the borderline where I started thinking about changing it over to, you know, is it favoring a buyer? But that particular one, we went back and looked at it, and it's the next slide. This number was artificially high, and I'll flip to that right now. The number that's artificially high is this yellow line, and this period of time was when I was taking my benchmark data, and you can see most of the lines are horizontal. This one gold line stood up, and you know, during that short period of time, the particular properties that we're selling were more expensive. So that pulled up my median for that one data point. Now we're going to go into looking at weekly data. We have 11 different metrics that I look at the market on, and each metric has 5 different graphs. I will only be discussing one of the 5, and we'll step through the others. So we're going to discuss this, which is days of unsold inventory. This is looking at single family home, the red line in Santa Clara County. The gold line is single family home in San Mateo County, and the gold line is condo townhouse in Santa Clara County. The most noteworthy thing on this particular graph is the condos were doing the best before shelter in place, and they're now doing the worst. That is noteworthy. The single families seem to be doing just about the same, with Santa Clara County doing better than San Mateo County beforehand and after. And that is an unusual situation. San Mateo County is normally about 4 days faster than Santa Clara County. So the fact that it was like 3 days slower up here is pretty unusual. They're the same right here. Now again, you can see San Mateo was slower, caught up, and now San Mateo is slower. So not sure what to read into. And again, these flat lines here at the end are based on just 1 week of data and 3 weeks of data. This is stepping through the other areas. And now we're looking at median days on marketplace. And these are the 3 counties. This was not the market improving. This was the freezing of days on market by the MLS. And the stair stepping was not necessarily an improving the marketplace, but just getting back to where the data was meaningful. So from basically here forward, the data is meaningful. And you can see, you know, you're right here, you're just fluctuating for San Mateo County. San Mateo County is now somewhere around, I guess that's 11 days. Santa Clara County is at 10 days and now dropped down to 9 days. So for 50% of your homes to sell in 9 days in a pandemic, it's pretty incredible. Now we're going to look at inventory. We'll look at this at everywhere, because here, these are the smaller micro market areas. The county data stands out because they're the largest. And this is basically my definition of inventory, which differs in almost from everybody else's. But I'll argue with anybody. I believe my definition is right. And a listing that has an offer with a buyer that can close escrow on it is not available to another buyer. And most other buyers and most other agents don't bother showing those properties. So that's not an available listing. and you get wrong information at certain times of the year, like the beginning of the year, where you have very little inventory. You go into the new year, you have a lot of inventory come on the marketplace. You have more buyers coming on the marketplace that gobble up those, plus gobble up some of the ones that were on the marketplace, putting a whole bunch of listings in the pending continue to show category, having most people say inventory is increasing, when in fact the available properties available for the next buyer has decreased, and my data would show a decrease. So I just don't understand the logic behind it. Here's stepping through the different areas. Now we'll look at the number of offers accepted in the past 5 weeks. You can see that we've recovered. This normally is going down, so the fact that it's still plateaued is a good thing. The fact that this is an indication of why I question the value of this shorter period of data, because you'll notice they all jump up. And I think the reason they're jumping up is there hasn't been enough time for the transactions to TFT when I'm only looking at 1 week back. So I think I'm going to start saving myself some effort and not doing that going forward. Stepping through the different areas. Now we'll look at the number of closed transactions. Same pattern. You come back up. This stays up higher longer, but you know it's still pretty robust. You can see the different areas. Now we're looking at frequency of overbidding. Frequency of overbidding says how often does a seller get more than their asking price. And so you can see we're all basically right around 50%, which is a pretty good marketplace. Stepping through. Now we're looking at magnitude of overbidding. Clearly, we're not back to the same magnitude of overbidding we were before. But again, that doesn't surprise me. I've noticed this after every hit to the real estate marketplace, whether it's 9/11, whether it's the 2007 financial meltdown. Buyers now realize that real estate goes down in value. Even in this case, it hasn't, but they get shook and their core values get shooken, and they go, do we really want to pay 20% more? Do we really want to pay 70% more? And so they're willing to overbid, but they're a little more tighter on how much over the seller's asking price. So this actually puts a bigger burden on the listing agent to make sure they price a property correctly during this period of time. Stepping through the different micro markets. Now we're getting into price. So this is looking at the 10 percentile price in the different areas, and you can basically see we're fairly flat. You know, now granted, if you go back to the beginning part of the year, you were at 800,000 for Santa Clara County, and now you're at something like 850,000. That's really not flat. That's up 5%. It's hard to see, but you know, every one of them, the trend is up. The biggest trend up is the San Mateo County, and if I was to guess, this might be like 925 for the 10 percentile at the beginning of the part of the year. And you know, you're clearly at 1 million here, and right now, even if you don't go to my predictions, you're at about 1.1. So you went from about 925 to 1.1 million. That's a pretty significant increase. You can see they went up even more right at the shelter-in-place time frame. And you know, yes, I'm after shelter-in-place, but that's because it takes another 4 or 5 weeks for the closings to reflect in the data. Stepping through the different areas. Now we're looking at the 50 percentile price, which is what most people follow. Same pattern as the lower price for the most part. I would say San Mateo County, you know, it went up, it came down, it went back up. Santa Clara County went up, dipped down ever so slightly, and is right back up. Condo townhouses tend to be more stable, and that's basically what you said. You know, they've fluctuated a little bit, but you know, looking at these trends, they went from, you know, I don't know what number I would call that, maybe somewhere around 780 up to 800,000, maybe 810, down to 790 up to 800,000, and essentially 800, maybe 810 right now. You know, maybe 810 back here probably. Stepping through the different micro market areas, and now we're looking at the 90 percentile price, and here you have a lot more fluctuation because you're talking about expensive homes. So a 10% change in price on an expensive home is much more dramatic. And so you can see bouncing a little bit more, especially in San Mateo County where the homes are more expensive, but even in Santa Clara County. But again, the trend is basically up. So no price segment of the market's really being treated differently than another price segment of the marketplace, which is nice to know. Stepping through the different areas. Now we're looking at the duration of escrow. I won't spend much time on this because it's not very significant, but basically you can see the duration of escrow before shelter in place was below 30 days, and now you're essentially at 30 days. Yes, San Mateo County is sitting at 29 days, but that's basically 30. Now we look at the data that makes this up. This is data as of today, the 15th. You can pick that where your favorite data point is. Some of the data that are important are sort of segmented here. Days unsold inventory is pretty important. Noteworthy is South County at 18 days. That is currently the fastest, and they're normally 75 to 180, 150. They're just on fire for South County. And then you have the magnitude of overbidding here. And it's interesting that even though they're on fire, both their magnitude and frequency of overbidding really is not where I'd expect it to be. And I think it's because the agents and the consumers down there just aren't used to overbidding. And so they're not doing it, even though their market's faster. You know, in our area, if they were something like 18 days of unsold inventory, this number would be 105%, and this number would be probably 80%. So I find that interesting. Their inventory is flying off the shelf, but they're not raising the prices and they're not bidding up to get them. So it doesn't make sense. But this is San Mateo County. This is condos. This is July data going back for 20 years, so you can just see where we are relative. And that concludes it. And after this, I'll step through it quickly if I have time. But I want to break now and take questions if anyone has some. All right, I'm not seeing anyone asking questions, so I'll just go through. And this is the monthly data. This was done at Semilog, the request of somebody. And so basically the slope of this line shows you the long-term appreciation. Here we're going back to 2000. Here we're going back to 2010, so you can see it. And this is on analog graph that you're more used to seeing. You can see the upside down sine wave with every year with prices. Here's going back 20 years. This is the magnitude and frequency of overbidding. The frequency of overbidding is down here. So right now we're somewhere approaching 55%. The magnitude of overbidding is somewhere right around 100. I think it's about 101.6% if I remember the number correctly. This is going back 20 years. This was a nod for the stock market where they have a price decline ratio. They look at the number of units, which is actually more meaningful. I'm just looking at the ratio between the overbids and the underbids. I don't think this was done at the request of a couple people, but I don't see it gaining us anything. If I come up with an easy way to do the units above and units below, then it would be more meaningful in my opinion. Here is looking at what the blue line is the most significant one. That's days of unsold inventory. And you can see for the last 10 years, we've been mostly in a seller's marketplace. You can see shelter in place happen. We went into a balanced marketplace for a short period of time and we're back on. The other two are median days and average days on marketplace. One interesting note is the days of unsold inventory is rarely in what I consider a balanced marketplace. It transitions between a seller's marketplace and a buyer's marketplace through a balanced marketplace, but it tends to spend very little time in a balanced marketplace. And you can see that in sort of this graph. This is basically the same graph going back 20 years. So here we transitioned up. We spent a little bit of time up here. We transitioned down. We transitioned back up, spent some time, transitioned down, transitioned, spent some time up here. We're improving down through here, and now we're basically back down in a seller's marketplace. Don't have data, but since I've been in the industry since 1981, in 81 it was clearly a buyer's marketplace, and you've had the ebbs and flows. But basically, since about Thanksgiving in '97, more often than not, we've been in a seller's marketplace locally. Now what I'm doing is trying to look at a 12-month moving average. So I'm looking at my data, and my data is, the first of a month for the next 5 weeks, so 35 days. So I take the data for July 1st, up through and including August the 4th, because that would be 35 days, then go back June, June, May backwards for 12 months and plot out the data and look at where you are. So you can actually see our inventory is going down based on that, but it actually went up. I'm not able to really pick up any trends on this. The DUI is real time, not the average. So that's why you're having some more fluctuations. And you don't have the squirreliness because it's only a single data point once a month instead of daily data. 10 percentile price ratio to the median price, the 90% ratio to the median price. So what you can see here in 2000, we were having price compression. In other words, the lower end was coming up in price and the top end was coming down a little bit. Basically, we had the mortgage meltdown. That caused the lower end to fall out. Didn't really impact the upper end. So you had price expansion where the range between the 10 percentile and the 90 percentile was expanding, and it stayed expanded, and we've had a little bit of contraction recently. Here is the sale price to list price overbid graphs. This is just on a monthly basis. So now you can see going back in time where we are. Go out back to 1997. You can see we're basically in the middle of the pack. One of the things that's impacting buyers is where you've spent the recent years have all been better years. So even though this year, which is in red, 2020, is a good year, it's sort of negative in a lot of people's mind because the recent years were better. But historically, this is right in the middle of the pack to a little bit above the middle of the pack. Here shows the same concept, just more recent data. So you can see, again, there's been a lot more years above than below, but again, it's sort of in the middle of the pack. Here would be the middle of the pack towards the low side, and that's going back only to 2009. And then this is the last 13 months, and if we go through this, what you'll see is we've been actually improving. So now here is June data down here. July is the most recent data. So here's June data, here's July data. April data is better, and March data is even better, but that was because this was before shelter in place coming down, turning the corner and going back up. Here we are this month in July, because remember I had to go from July 1st for 35 days, so this is data through August the 4th, which wasn't that long ago. It's still better than we were in 2019, like September of 19.